Okay, guys, so welcome to another episode of what's happening in today's markets, which is Thursday, the 29th of October. And yesterday I did post a video talking about the market. So we saw France and Germany implement lockdown measures to prevent the coronavirus spreading across their countries. So they're now closing bars, gyms, restaurants, trying to limit the amount of social interaction that could be happening inside France and Germany because deaths are rising at a rapid pace, cases are rising at a rapid pace in both countries, and the rate of infections and hospitalizations, if I said the word correctly, is actually worse than the breakout in April. So that is basically making the scientists forecasts that if there's no lockdown measures, that deaths could be at a much higher rate than we had earlier on in the year. So of course that's not good. No one wants that. So it's a bit of a challenging situation for the French and the German governments to have to implement more lockdown measures because they don't want to damage their economies, but they have to save lives. So what does that mean for the market? So yesterday we saw the stock markets crashing aggressively because remember, if there's lockdown measures, people are not going to be spending money as much. Companies are going to miss out on their earning forecasts. The share prices or stock prices for these companies are going to be dropping because now markets are going to realize that the expectations they had for growth in 2021 may not materialize, and that's causing all of the stocks within the indexes to crash, and then you get a situation where stock markets start to dip lower. So we saw a nasty sell-off in the German 30 index, we saw a nasty sell-off in the French index, in the stocks Europe 600 index. The S&P 500 drops lower. Oil prices dropped aggressively lower as well yesterday, and the commodity currencies weakened because of their exposure to oil prices. So there's a lot of trades that we can play in the market. So what I'm going to do is I'm going to run over all of the trades that happened in the first part of the year from April 2020, when the pandemic really started to grip the world, when restrictions on travel was implemented. We saw loads of currencies weaken, we saw stock markets weaken, we saw the commodity currencies weaken, we saw commodity prices weaken. So if this third or second wave as they call it, or just a resurgence of this virus does play out, then the same moves we saw earlier on in the year are very likely to play out again. So you can basically just use history as a guide to tell us what we want to be doing in the market. So I sold oil yesterday. My members and I are in some really good profits this morning from that oil trade. We sold the German 30 index yesterday, made some really good trades. And now there's going to be some more trades to jump into. And basically, I'm just going to show you everything that I witnessed in the early parts of the year. This was the first stock market crash I've ever experienced. So it was a very good learning curve for me. I actually did well during it, but forget about just doing well. It was more about learning. I'm all about learning, all about bettering myself, and all about understanding how to take advantage of situations that will reoccur in the future. Maybe it may not be a virus, maybe it could be another financial crash, but we just have to understand how the markets historically move so we can take advantage of that. So that's what we're going to do now. I'm going to go over to the computer screen. I'm going to show you this. Hopefully you take this in. Hopefully you make money off it. If you do, I'll be really happy. And remember, guys, please leave a comment in this video, give me your feedback, and remember you can come and join my free trading channel on Telegram for some market analysis as well. So let's go over to the computer screen. Thank you. Okay, guys, so welcome over to the computer screen where we're going to look at a multitude of trading opportunities in the markets if we get the same kind of moves we saw in the early parts of the year, driven by lockdown measures implemented across Europe, across the United States, and Asia. So we had Germany yesterday implementing lockdown measures, France implementing 1 month lockdown measures, the UK is expected to implement lockdown measures, and we got record numbers of cases rising in the United States also, which is going to undoubtedly at some point lead again to lockdown measures in certain states, so on and so forth. So what we're going to do, we're going to go through the commodities, so oil, the commodity currencies that are linked to the price of oil. Then we're going to look at the indexes in the stock markets, and then we're going to have a look at the Japanese yen and the US dollar, because these two are the safe haven currencies that will strengthen during these risk off sentiment moves. And then, of course, as well, how the indexes are going to perform in a scenario of further lockdown measures. So let's just start off by looking at the oil price. So we must remember that in the early parts of 2020, oil prices did drop dramatically because of the demand outlook outweighing the supply of oil in the markets, and it was really detrimental to the oil price, which dropped dramatically by around 70%. Currently, it's still down 47% from the highs of the year, but oil is now moving again to the downside because, again, further lockdown measures across Europe will mean that there'll be less people using oil in their cars. If people have to stay and isolate inside their homes, if there's a nationwide lockdown, then the demand for oil drops. The airplane industry will be hit even harder, less flights, less bookings. And then you get to see the picture where if borders are also closed, so the spread of the virus can't come from other countries into their countries again, then again, manufacturing takes a hit, and oil is a big component in the manufacturing industry as well. So oil is used for so many different products. So if travel is restricted, if borders are closed, if the demand for oil crashes, then you get a situation where the price of the commodity dramatically drops in the markets, as we saw in the early parts of the year. So in the first part of the drop that we saw at the beginning of 2020, oil prices were down 35% because the demand was dropping dramatically whilst there was still being the same supply being brought to the market by the oil producers that are part of OPEC. And then we had Russia and Saudi Arabia getting into a price war, which caused prices then to drop even more dramatically. But prices did still drop by 35% in a matter of weeks. So we're already seeing oil prices start to dip lower. And if we get these nationwide lockdowns across Europe, and if the US starts to implement this as well, and undoubtedly Asia will probably get hit with another wave of infections as well because the virus spreads in colder climates and we're now going into winter, then we can start to build a picture as what's likely to happen. So with that being said, oil price is really driven by demand and supply. But obviously, OPEC, the oil producing members, will cut supply or try to minimize supply when there's an increase in demand because that just helps the price of oil rise. So at the moment, what we need to look at is historically what we need to look at in terms of economic data that gives us a strong understanding of what drives the oil price. So first of all, we understand that the US is the world's biggest economy. Okay, the US drives global growth. And if the US is growing, then the rest of the world is also growing. So I'm going to show you ISM manufacturing. Once you understand ISM manufacturing, you'll understand how this is used to predict oil prices, and I'll show you the correlation between the two. So manufacturing PMI has an 85% certainty in predicting GDP growth in the United States. Going back to 1947 is when we look at the data. And what you can see is when manufacturing is above the level of 50, highlighted in blue, which indicates growth, you have positive prints of GDP growth highlighted in red. And when manufacturing PMI goes below the level of 50, we have negative prints of GDP growth highlighted in red. You can clearly see how closely the two move together. So it does give you a strong view of how the manufacturing data is predicted to show whether the US economy is likely to grow or not. Now, if you're looking at how this affects the oil price, because the US is the world's biggest economy, when we look at historical data, we can look at the PMI data of the United States compared to oil prices. Now, look how strongly the two are correlated. So when you get manufacturing going below the level of 50, indicates a contraction in growth in the US economy. Remember, the US is the world's biggest economy. Automatically, we get a contraction in the oil price dropping and getting weaker. And then when manufacturing starts to go back above the level of 50 and indicate growth, the oil price follows the manufacturing data and predicts whether oil demand will be increasing or decreasing. So at the moment, the manufacturing data is above the level of 50, but if we get nationwide lockdowns in the United States and we get nationwide lockdowns in Europe, now we get a picture where oil demand is likely to decrease dramatically and the oil price will strongly follow. But you can clearly see how strongly the two are correlated. And you can see the same in Europe as well. So if we look at European manufacturing data and the oil price, you actually get the same scenario when we compare the two. So let me just go back over to apologies. So if we look here at European PMI and the oil price. Oh, sorry, I don't know why the chart didn't come up there. Must have been loading slowly. But again, you see the same situation. When European growth is predicted to contract, the oil price drops lower. And the European growth situation is set to improve, the oil price strongly follows. So what does that mean for us at the moment? The manufacturing PMIs in Europe are above the level of 50, but with all these lockdowns coming across Europe now, we may see manufacturing go below the level of 50 again. And you can already see that the oil price will follow the European manufacturing PMI alongside the US manufacturing PMI. So what that means is that if we do get these lockdowns in Europe and we do get lockdowns in the United States, oil prices are going to fall again because we're predicting lower growth in Europe, lower growth in the United States. That's telling you we're going to get lower demand for oil. And that's the situation now why oil prices are already now starting to move to the downside, because markets are starting to price in the expectation of lower demand and lower growth in Europe and the United States. If we get the same situation in China as well, even worse for oil prices, we're going to see even more selling in the market. So in that scenario, what I'm trying to say is if we get lockdowns across Europe, so if lockdowns come in the United Kingdom, if the virus keeps spreading across the US and the markets start to talk about lockdown measures and we start to hear the government's talking about lockdown measures, we want to be selling oil and holding the oil price to the downside until the situation looks like the lockdowns are going to be eased, and then we can buy oil back again and try to catch the trend in the opposite direction. So that's the oil price. We understand what will be driving the oil price, but what we do need to look at also is the commodity currencies that are linked to the price of oil. So let's look at Russia, for an example, the Russian ruble. Now, in the early parts of the year, the US dollar dramatically strengthened against the Russian ruble. We saw the dollar go up against the ruble by around 35%. And there's no coincidence that when you compare, let me just get two charts up. When you compare the oil price to the US dollar ruble, you can see how strongly the two are correlated. So let's just zoom out here and look at the US dollar ruble. So we saw the US dollar go up against the Russian ruble dramatically by around 35%. And this was during exactly the same time that oil prices were dramatically dropping as well. So let me just change this to a weekly chart because it just has less candles and it's easier to view. So we can see here, that's the weekly chart of oil. And let's change this to a weekly chart as well. So here we go. You can clearly see that when the oil prices were dropping from around January, we saw immediately the US dollar strengthen against the Russian ruble. And then once the oil price started to recover, the Russian ruble started to recover again. But since then, there has been a lot of anticipation for sanctions coming against Russia, and that's caused the Russian ruble to strengthen, to weaken again. But also, we've seen in the last week when oil prices have dropped quite strongly, again, look how strongly we've seen the US dollar strengthen against the Russian ruble. And why is this? It's because Russia's main export is oil. If you look at this economic analysis of the economy, over 50% of Russia's exports is oil. So that is a major driver that helps the economy grow. So if oil prices are dropping, this damages the economy of Russia. And because oil is sold in US dollars, the central bank is likely to cut interest rates to weaken the value of the Russian ruble against the US dollar to make sure that their oil exports are cheaper in the international market. So that gives you another idea about buying the US dollar against the Russian ruble if oil prices do continue to slide to the downside. And then, of course, when oil prices start to recover, then we can buy the Russian ruble back against the US dollar. It's exactly the same situation for the Norwegian kroner against the US dollar also. So we've seen, again, in the early parts of the year when oil price was dropping, the US dollar strengthened against the Norwegian kroner. And then when the oil price recovered, the Norwegian kroner strengthened back against the US dollar. And why is this? Because Norway's main export, again, is oil, accounting for over 50% of the country's exports. And their biggest export market is Europe. So if Europe is going to be contracting in growth because of lockdown measures, that hurts Norway. And then we get an idea about how to trade the currency. So again, if oil prices do drop dramatically and aggressively, we want to be buying the US dollar against the Norwegian kroner. And that gives us an opportunity to trade the correlation between oil prices and the Norwegian kroner. And on the flip side, when oil prices rise, then we can buy the Norwegian kroner back against the US dollar. Same could be said for the US dollar against the Canadian dollar. Again, Canada's main export is oil, accounting for around 20% of its exports. So that explains now why when the oil price dropped in early January, the US dollar got really strong. And when oil prices recovered, the Canadian dollar strengthened again. So clear correlation, and you could trade it exactly the same way as we highlighted for the two currencies there. So that's looking at oil and the commodity currencies. Another thing we must look at also is the US dollar against the Aussie dollar. Now, why is this? This is because, again, Australia's main export is iron ore. So if we go to the Australian economy and we have a look, iron ore is Australia's major export alongside coal. And when we have a look at the Australian economic analysis, we can see that iron ore prices highlighted in red and the value of the Aussie dollar, US dollar highlighted in green. Look how closely correlated the two are. And why is this? Because again, iron ore, similar to oil, is a commodity, and the demand for iron ore will be driven by global growth expectations. So if global growth is going to contract, the iron ore price will drop. And if the iron ore price drops, the Australian Central Bank has to cut interest rates to lower the price of the Australian dollar to make sure that the exports of iron ore, which is sold in US dollars, is sold at a lower price. So you can clearly see the correlation between the two, which means that when you look at, for an example, another interesting way to view this is if I show you a chart here and I compare the Aussie dollar, US dollar exchange rate to the S&P 500, look how closely correlated the two are in terms of their price movements. Look how closely correlated the two are. They literally move exactly the same. Even when there's pullbacks in the Aussie dollar, US dollar, it's at the same time there's pullbacks in the S&P 500. And then look, you can clearly see the correlation. So why are these two so correlated? Because again, remember global growth expectations. The US drives global growth. So if the US economy is going to be contracting, that means the demand for commodities will be falling, and that will have a big impact on the Aussie dollar, US dollar exchange rate. So you can actually let me show you on a daily chart. I think you get a much better picture of the correlation between the two. Yeah, here we go. So here, look, you can clearly see the correlation, how strongly correlated the two are. They literally move side by side with each other because, again, remember, the US leads global growth. If the US is growing, the demand for iron ore is increasing, so the Aussie dollar strengthens. If the US is contracting, then we see the iron ore price dropping because global demand for its export is dropping also. So why would that have an effect on the S&P 500? Because again, remember, the S&P 500 is an index, and markets use growth expectations in a country to decide whether to buy or sell a stock market. If there's going to be growth in an economy, they're going to buy the stock market. If there's going to be contraction in the economy, they're going to sell the stock market, because companies are going to be either making more money during growth periods or they're going to be making less money during contraction periods. So during slow growth, you sell stocks, and during high growth, you buy stocks. It's called cyclicals. Okay, so that gives you a better understanding of how to trade the Aussie dollar, US dollar. So if the US stock market starts falling, we definitely want to be selling the Aussie dollar, US dollar. And if the stock market starts to recover, then we want to go back into the Aussie dollar and buy the Aussie dollar against the US dollar. And it's the same situation for the Aussie dollar. Also against the Japanese yen. Same situation. If we look at the Aussie dollar, Japanese yen, and we compare it to the S&P 500, you pretty much get the same picture as well. And the reason I'm showing you this is because the Japanese yen is a safe haven currency. So whenever stock markets are falling, the yen automatically gets stronger. And when stock markets are rising, the yen automatically gets weaker. So you're going to know when to buy or sell the Aussie dollar, Japanese yen based on what's happening in the stock market. So that's explaining the Aussie dollar and iron ore prices. So that's another trade idea you can have based on what's happening in the stock markets. And then we can actually have a look at the stock markets in itself. And most importantly, let me show you the economic data that tells us when to buy or sell stock markets. So the manufacturing PMI, as I showed you, predicts GDP growth going higher or lower, but it also predicts what's going to happen in the stock market. Because if you look at this chart here, if this will just load, stop moving so slowly, you can clearly see here, manufacturing PMI and S&P 500 move very closely in correlation. Why is this? Because Again, remember, manufacturing is predicting growth or contraction when it's above or below the level of 50, and the market's then using that expectation for growth to be growing or contracting over the next 12 to 18 months. They're then taking that view and then buying or selling the stock market because they understand that the manufacturing PMI is a leading indicator predicting growth in an economy. So if we are seeing the stock markets falling because, let's say, there's another lockdown measures implemented in the United States, growth expectations will be growing lower, then we know immediately we need to sell the S&P 500 because, again, the leading indicators are telling us that growth will be contracting. So we can sell the S&P 500 if growth expectations drop on further lockdown measures. And then if that is the case, then we need to be going short the stock market. If there's not lockdown measures implemented, or let's say the virus looks like it's going to be contained, or there's going to be a vaccine, then we want to be buying the S&P 500 because a Joe Biden election win will mean a big stimulus injection into the economy to help the US economy recover. And the last time that there was a massive injection of money into the US economy coming out of the last financial crash in 2009, look at the bull market that the US went into, a 10-year bull market where stocks were just rising year after year. So that's an idea of how to trade the US stock market. It's all going to be dependent on what happens on the election and is there going to be second lockdown measures. We can also look at trading the European stock market. So I recommend selling the stock market at the moment because all these lockdowns in Europe is just going to hurt the European index. So it's looking like we should sell the stock market. And again, once the lockdown measures are eased, then we can look to buy the stock market back again and go long. Same for the German 30. We saw sell off aggressively yesterday. If Germany's economy gets hit and growth starts to really look like it's going to contract, we sell the stock markets. And then once the lockdown measures are eased, like there was earlier on in the year, then we can start to buy the stock markets back again and we can take some long positions. Now, looking at the US dollar. The US dollar got very strong at the beginning of the year when the stock markets were crashing because, again, the dollar is the world's ultimate safe haven currency. So if that plays out again, we want to be buying the US dollar across the markets, especially against the commodity currency. So you want to be selling the Aussie dollar, US dollar. You'd want to be selling the New Zealand dollar, US dollar. You'd want to be buying the US dollar against the Canadian dollar, for an example, or buying the dollar against the ruble, like I suggested, or buying the US dollar against the Norwegian krona. And then again, once the demand strongly for the dollar decreases, then we can look to take the reversal trade and come out of these trades and go the opposite direction. So that shows you the demand for the US dollar in the markets is always going to be driven by stock markets crashing because markets are then going to be selling off their stocks, buying US dollars, and then holding those dollars because, again, the dollar is the world's reserve currency. One more thing to look at is if the US economy does go into a big sharp contraction, you're going to get a huge stimulus package come from the US government. And remember that when you get stimulus, this is inflationary, and this is why gold has been rising so aggressively over the past few years. You can see gold is really on the upturn, and that's because interest rates have been cut aggressively in the United States. Interest rates are getting cut aggressively across the world. And when you cut interest rates, that means investors cannot buy bonds, government bonds, which are traditionally the safest way to protect yourself against inflation. They can't buy these bonds to protect themselves against inflation, because the bonds are not producing a high enough return above the level of inflation. So if we take the bond yield, for an example, we take the yield paid on a 10-year treasury bond, and then we contract a 2% inflation rate, then we can expect gold prices to continue to rise because investors cannot be protecting the value of their dollars from inflation, because at the moment they're losing money every single year because the rate of inflation is higher than the 10-year government bond yield paid when you buy a treasury bond. So the interest is not protecting your wealth. So investors have to find an alternative to holding cash because of inflation rising. And then you're going to get gold prices continuously moving to the upside. So in that situation, we've already seen gold. If you actually look at the bigger picture tells you a bigger story for what's actually happening. Gold since 2007, since huge stimulus has been pumped into the US economy, you can see that gold has gone up by nearly 250%. So the trend is clear. about gold being used as a hedge against inflation. And if, again, we get more lockdown measures and we get huge stimulus packages implemented by the US government, then we're going to see oil prices move to the upside. And that's our situation to buy gold, go long, hold this commodity price, and make some really good profits on the upside. So we've looked at the commodity currencies, oil prices, Australian dollar, the Japanese yen. We've looked at the US dollar's demand indexes, and now you've also had a look at the gold price. So there's a lot of ways to play this pandemic that have already played out this year. So if history is going to repeat itself, we know how to trade, we know how to take advantage of these moves in the markets, and then we can look to make some profits as they do play out. So I hope that makes sense, guys. Thank you for watching this episode. Again, subscribe to my YouTube channel, and I'll keep you guys updated in the markets. Thank you.